Welcome to our weekly market review. It's brought to you by Treasury One and ETM Analytics. As per usual, I'm joined by currency strategist André Cilliers. André, we're heading into the fourth and final quarter of 2025, and man, what a year it's been. Obviously, it's also the end of the month. This week, South African data is going to be a bumpy ride as well, with a slew of data coming out. But really, the big focus turns back to the US. So we obviously following the impending or possible government shutdown if the Democrats and Republicans can't find a way to cross the divide over the aisle. But another interesting thing, obviously, is last week's inflation data that came out for the US, which just again reaffirms this sticky inflation that just doesn't seem to give away. And it's growing more and more concerning that the US might find itself in that trap of the low growth and the sticky inflation that's just not budging.
Yes, good morning to everybody. In my days, you got something called sticky toffee, and now you get something called sticky inflation. We've spoken about inflation for a long time, and we've always said that there's two things that they focus on. That's jobs, unemployment data, and inflation. Now, the inflation, we have said that it looks like it is coming down, but it's not coming down, and people are still spending money. So if you look at their retail sales, then they're still spending in the economy. If they're still spending in the economy, then we all know that as long as people flock to the shops, the shopkeeper is not going to lower his prices. So how does their savings look? Well, their savings is dwindling downwards. So eventually, if your money in your savings account dries up, then you will get inflation to come down, because then the shopkeeper needs to lure people back into the shop to come and buy. So it seems that it's coming more from the higher end spending from people in the Americas, and that still, as I then say, helps the retail sales, and that keeps the inflation sticky. And we know that Mr. Powell, and he's got a couple of months left before he needs to go sit wherever he sits when he's not working, and the person that's going to take over from him is not being nominated, so that becomes an uncertainty. But for the moment, he's there, and we know that his focus is squarely on those two things. And if you look at both those things that he needs to focus on, then yes, we've seen that jobs data is also beginning to show signs of cracking and dwindling down, but for the moment it's not a massive downturn. So it's still there, and that means he can kind of focus on data coming out, which is set for months on end, will be data dependent.
Yes.
And the data tells us he can still be a little bit stubborn. Markets are at times getting a little bit ahead of themselves, discounting how many interest rate cuts we're going to have, how soon we're going to have them. But the data says Mr. Powell can not have to be worried to become too aggressive, and can be data dependent, seeing how things come out.
I think I mentioned it last time. We had a look at the excess savings that followed the COVID-19 pandemic stimulus and the money that was pumped in. I think at its peak, it was just over 2 trillion, 2.3 if I'm not mistaken, and it's dwindled. I think we're tracking now to 20 billion around. So it's completely almost depleted, and that's really what's been propping up the US economy. So, I think that the question now that we are getting from a lot of clients is not so much about whether the downturn is coming, but it's about how deep it's going to be. And that is a very interesting conversation for another day. Of course, the more pressing problem for the US is whether or not the government can keep its doors open, as the Republicans and the Democrats are at each other's throats about certain policy legislation that they need to find common ground with. But the Democrats wanted a meeting with the leaders actually from both houses from the Democrats wanted a meeting with Trump. He cancelled it. So you have this back and forth, and it's really, and I spoke to some people last week about this. This is really just an extension of this deep polarization that we've been seeing in the US. And I know with this government shutdown over the years, there's been a number of these events that's kind of leading up to it, and the headlines look all doomsday, and they always strike a deal at the 11th hour. And we kind of expect it to happen again this time, but yet there's still that very strong they're very divisive at the moment. And I'm not seeing them really reaching across the aisle to compromise and meet each other. But, like I said, I think we'll just see what we always see, and they will find a way to pen some sort of deal just before the clock strikes 12 tomorrow night.
Okay, so this is an interesting one. This is an annual thing. They simply don't have enough money. They need to lift the ceiling where they can go to the markets and borrow more money to keep the government machinery going. And this time around, it's revolving around medical aid subsidies, medical healthcare subsidies that Donald Trump took away. The Democrats is at loggerheads with him about that. They want it back. I think this time around, we have to keep in mind, if you look at everything over the last couple of months, I don't think that the division between Democrats and Republicans is a high point. It's never been as big, that division, as it is currently. Will they find and strike a deal? Yes, they will. We have to see how they strike this deal, because I think how they strike this deal could have an impact on the way forward between these two divisional spectrums of political elements. And it would have an impact on how aggressive Mr. Trump goes ahead, or how he becomes a little bit toned down. So that's the important one. But they will strike a deal. It might be a day too late or 2 days too late, but they will strike a deal. So I'm not too concerned about that. I want to see what is the deal that's being struck.
What is in the details
at this point?
What
is in the details?
I said earlier on, obviously domestically for South Africa, there's a string of month-end data coming out. But even so, this is likely to influence around more than anything that we are going to see being released domestically. I know vehicle sales is one data set that we like to follow, just as an indicator of consumer sentiment, what's going on. But we'll be looking to the US for the direction of the rand this week, right?
Absolutely. So if we look at the rand, then it's for immediately not forget that it's the 29th of September. Tomorrow is the 30th. If the clock strikes 12, it's not a question of a very nice thing turning into a pumpkin. It's a question of there's no AGOA anymore. Now, okay, so AGOA at this point in time, does that affect us that severely? Not really, because the tariffs in AGOA, we are paying 30% in any case. But we also know that there's a whole delegation in America currently discussing the way forward. Will there be an agreement? Will there not be an agreement? Will there be a lower tariff? Will there not be a tariff? And now gets thrown into the bundle. Also, will there be an AGOA going forward? Will there not be? Will we be part? Will we not be part? So that could influence the rand a little bit this week. But at the moment, we're riding the wave. Gold trading above 3,800. Platinum working its way towards $1,300 an ounce. So we are riding the wave of high commodity prices. We're riding the wave of uncertainty, and that uncertainty weighs on the value of the dollar. Yes, it did gain some traction again. It was up at the 118s, it came back down, but the euro and everything still fights back all the time. So this uncertainty benefits the commodities. that benefits South Africa, because this time around it's not just gold, it's on a wide front of commodities that we get the benefit. And the uncertainty and our high interest rates, etc., still benefits that carry trade, and we see that in the value of the rand. I have no reason to believe that we're about to run up to 18. I have no reason to believe that we will break the 17 very quickly. I think we're in a trading range at the bottom end, 17, call it 1710, 1760. That's our trading range. What could most probably narrow that even down, but we are having the benefit, and I think that benefit will continue in spite of discussions around AGOA and other tariffs.
There's definitely certainly a lot of uncertainty around AGOA. There's been some headlines of extension, but it's been fairly quiet. So it's going to be very interesting to see what comes out of it tomorrow and the days that follow. André, thank you very much. We will be tracking everything, and then we will catch up again next week.